Warren Buffett once expensed the same business lunch twice. Once to his company, once to himself. And he did it completely legally, completely intentionally, and it made him richer both times. That is not a loophole. That is not a gray area. That is a fundamental behavior that separates people who build wealth from people who just earn money. And nobody teaches it in school because the people running schools never needed you to know it. Here is what is actually happening. When a self-made millionaire runs a business, they do not just pay for things and move on. They run every dollar through a system. A system that creates two financial events from one transaction. And if you have never heard of this, it is not because it is illegal. It is because understanding it requires thinking about money the way business owners do, not the way employees are trained to. Let me make this real. Say you take a client to dinner. The bill is $200. You pay out of your personal account. Now here is where most people stop. They paid $200. The dinner happened. Done. But a business owner does something different. They submit that receipt to their own company for reimbursement. The company pays them back $200. Now the company also records that $200 as a business expense. That expense reduces the company's taxable income. So the dinner ultimately costs the company far less than $200 after the tax reduction kicks in. And the owner was made whole in their personal account. Two financial events. One receipt. Both legal. Both intentional. Now your brain is probably asking, wait, do you need a company for this? And that question right there is the most important thing I can say to you today. Because the answer is no. Not a Fortune 500 company. Not even an LLC in most cases to start. You need a documented system and a mindset shift. You need to start thinking of yourself as an economic entity, not just a person with a job and some expenses. Here is the deeper layer. This is not really about receipts. This is about a discipline that the wealthy use to force themselves to think about every dollar twice. Once as a personal expenditure. Once as a potential business asset. That dual tracking habit is what builds Fortune 500 discipline in people who started with nothing. Let's talk about Sarah Blakely for a second. She started Spanx with $5,000 and no investors. She did not start with a dual reimbursement system. She started with a notebook. She tracked every single dollar she spent on building that business. Every prototype meeting, every legal fee, every phone call. She treated herself as both the business and the employee of the business simultaneously. That mental framework, that habit of documentation, is what let her later optimize every dollar when the business scaled. She did not stumble into financial discipline at $100 million. She built the habit at 5,000. The receipt loop is the physical practice of that mental framework. You are forcing yourself to ask, is this dollar doing more than one job? Can I route this expense through a structure that makes it work harder? That question, asked consistently, is how wealth compounds before the investments even start. If this surprised you, subscribe. We cover the financial behaviors that actually move the needle, the ones that financial media ignores because they do not sell products. Now here is the second layer that most people miss entirely. The reimbursement loop is not just a tax strategy. It is a psychological trigger. When you reimburse yourself from your business account, you are creating a separation. You are acknowledging that you and your business are distinct entities. That separation is the single most important mental shift a wealth builder can make. Employees merge themselves with their income. They think, I make $60,000 a year. That is what I am worth. Business owners separate themselves from the cash flow. They think, my business generates revenue. I am a separate participant in that revenue. That distinction changes every financial decision you make going forward. It changes how you think about raises. It changes how you think about side income. It changes how you evaluate whether to take a job or start something on the side. Here is the practical implication. You do not need to be rich to start this. You need to start small and you need to start now. Step 1. Open a separate bank account today. Call it your business account even if your business is currently just an idea or a freelance gig you do twice a month. Step 2. Every time you spend money on anything remotely related to earning income, a book, a software tool, a coffee with someone in your field, pay from your personal account and document it. Step 3. At the end of every month, review those expenses and reimburse yourself from the business account. Even if the amounts are small, even if it is $40, you are not doing this for the $40. You are doing this to train your brain to see every dollar in two dimensions. Asset or liability, personal or business, optimized or wasted. The people who build serious wealth are not smarter than you. They are not luckier in most cases. They are operating under a different set of rules. Rules about how money moves, where it sits, and how many jobs $1 can do before it is spent. The reimbursement loop is one of the simplest versions of those rules. And it has been hiding in plain sight inside every business accounting course that was never designed for regular people. You have been told to save more and spend less. That is not wrong, but it is incomplete. The real game is structuring how money flows before you save or spend it. The wealthy do not just earn and save. They root, they document, they reimburse, and they do it consistently, starting when they had almost nothing, long before it looked like it was working. Do not close this tab yet. The next video we posted breaks down the exact account structure that turns this habit into a real tax reduction, even if you are still working a 9 to 5. That one will cost you if you miss it.